You did the smart thing. You didn't bet on one company. You bought all 500, the S&P 500, in a single click. Maximum diversification. Except, look closer. 7 of those 500, just 7, now make up about a third of your entire investment. You didn't pick them, but you're mostly betting on them. Meet the 7. Apple, Microsoft, nvidia, Amazon, Alphabet, that's Google, Meta, and Tesla. Wall Street calls them the Magnificent Seven. Together, they're worth more than $20 trillion, and they have quietly swallowed the index that's supposed to be your safe, boring, diversified bet. It wasn't always like this. Roll back to 2015. Those same 7 names were about 12% of the S&P 500. A big chunk, sure, but you really did own a spread of 500 companies. Then the line starts to climb, and climb. The climb turns into a launch around 2023, the moment the artificial intelligence boom catches fire. Money pours into the handful of companies building it. Nvidia alone, the chipmaker at the center of it, swells to roughly 8% of the entire index. One company. By 2024, the 7 together cross a third of the whole thing. Those 7 now sit at around 35% of the whole index. And that's a record, not a 5-year record, a 90-year one. The last time the American market leaned this hard on its biggest view was 1932, in the depths of the Great Depression. Goldman Sachs put a name on it, the most concentrated market in roughly 90 years. So this is the part where I'm supposed to yell, bubble. But that's the lazy read, and it's only half true, because there's an honest case for why these 7 got so big. These companies make staggering real profits. Their margins run about double the rest of the index, and in 2024, they drove more than half of the whole index's earnings growth. So the weight isn't pure hype. A lot of it is earned. But here's the catch. 7 companies are about a third of the index's weight, and only about a quarter to a third of its actual earnings. That gap, weight running ahead of profits, is the premium. It's the price you're paying for the story. And we've seen markets get this top-heavy before. Twice the index leaned this hard on a glamorous few, and both times it did not end gently. In the early 1970s, it was the Nifty 50 blue chips. Everyone swore you could buy and never sell. Then the 7-degree crash hit, and some of those sure things fell 70, 80, 90%. Then came the dot-com boom. In 2000, Cisco was briefly the most valuable company on Earth. It then lost about 90% of its value, and didn't set a new high again until 2025. 25 years just to break even. But here's why this isn't just 2000 all over again. Back then, those leaders traded at around 80 times their earnings, priced for a fantasy. Today's 7 trade closer to 30 times, backed by real cash machines. So it's not the same reckless bubble, it's something subtler, extreme concentration in genuinely great companies, which is its own kind of risk. And that's the real takeaway. If you own an index fund, in your 401k, your pension, almost anywhere, you're making a big concentrated bet on 7 AI and tech giants, whether you decided to or not. It might keep working, these are phenomenal businesses, but safe and boring it is not. The most important bet in your portfolio is one you never actually placed. One last thing. After that record high, the line actually ticked back down a little in 2026 because concentration is never a straight line up and never a prediction. This isn't advice, it's just the receipt, the math of what you actually own on one chart. In one timeline,